Hi, my name is Spencer Leu, and today I'm going to talk with you about what is a PE ratio. A PE ratio is just basically the market price per share divided by the annual earnings per share. And those annual earnings are usually trailing, which that just means they use the last 4 quarters of earnings in this calculation. So let's take a look at the PE ratios for these 3 companies: Apple, Starbucks, and LinkedIn. If you go on Google Finance, you can find out the prices and the earnings per share. And for Apple's case, the current price is around $410. Starbucks is around $40 a share. And LinkedIn is at about $85 a share. Now, if we take a look at their annual earnings per share, in Apple's case, it's $25.26. In Starbucks' case, it's $1.52. And in LinkedIn's case, it's 7 cents. So 107. So if you just divide those numbers, for Apple, their PE is about 16. For Starbucks, their PE is about 26. And for LinkedIn, their PE is 1,214. Now, to kind of put this in context, the S&P 500, which is a broad index, is trading at a PE of about 14 right now. And historically, the PE for the S&P is around 15, but it has been as high as 32 and even higher than that around the dot-com boom and then the bust after. But just to give you some context here, if you just take a look at these PEs and compare it to the S&P 500, you would find that Apple's about in line with the S&P. 16 is pretty close to 14. Starbucks is a little more expensive at 26. And LinkedIn is really off the charts, and one of the reasons for that is they just recently IPO'd, so they don't have much earnings, but the market seems to think that they're going to grow and make more money in the future, so that's why their PE ratio is so high. So here are a couple tips for you when you're looking at the PE ratios of companies. The first is just to compare the PE ratio to other companies in the same industry. So I didn't do that. I was just illustrating 3 different PE ratios for 3 different companies, but you want to compare these to other companies in the same industry. Use caution when you find companies that are outliers. So if most of the companies in the industry are trading at about a PE ratio of 20, be careful if you find one that's trading at a PE ratio of 1,000. And one example of that was Enron. They were trading well above their competitors, and there's 2 things you can look at. One is, if they had a competitive advantage, then that would make sense that they were trading at such a higher rate than the other companies. But if you can't find out where that competitive advantage is coming from, you want to run away from those stocks. Conversely, there are some companies that trade at very low multiples compared to their counterparts, and that may be due to a variety of things. They also might not be a good company. But historically, and that gets to the third point, if you're investing for the long term, consider low PE companies. And again, sometimes they are just dogs, but over time, there's been some studies done, and it shows that investing in the lower PE companies, which tend to be more value, they're like cheaper or on sale, if you will, compared to their counterparts, does tend to yield better results over time. And of course, in the short term, the higher PE ratios, just like LinkedIn, tend to be hot and can do well. But for the long term, consider lower PE ratio companies. Well, thanks for watching my explanation of PE ratios. If you have a moment, please read these important disclosures. I'm Spencer Leu, the Finance Guy.